Those results, certainly in terms of profit and revenue at CN Rail, beating expectations, but the company did operate less efficiently. Its so-called operating ratio, a measure of expenses versus sales, was 63.1%. So that was a worsening from 62% in the same period a year earlier. Still, given the disruption from wildfires and labor disputes, you might think the results would have, or profit would have taken a bigger hit. We are joined by Bloomberg Intelligence Senior Analyst in Logistics, Lee Klaskow. Lee, thanks very much for giving us the time.
My pleasure. How you doing?
I know you haven't had long to look at these CN results, but what jumps out for you?
Yeah, I think the biggest thing was that their network really recovered from all the issues that they were having from the strike or the labor issues and the wildfires. The network of Canadian National was in much better shape in September relative to August. And you know how we measure that is really by their overall network fluidity, which is how fast the trains move and how quickly the asset turns. So what we saw is a massive improvement in asset turns and in train speeds in the month of September. So that was a net positive. You know, they did beat on lower expectations. They kind of guided lower last month just because of these two issues that we just mentioned, the strike and the wildfires. And it seems that, you know, that those issues are behind it, and they can kind of focus on continuing to improve their overall operations against a backdrop of, you know, probably tough demand, because, you know, it is, you know, demand's probably not as good as they would like it to be.
Now, you guys wrote a while ago that CN has been refocusing on scheduled railroading. What do you mean by that? Have they been tightening up on the actual times that trains move?
No. So when we talk about scheduled railroading, we're talking about precision scheduled railroading, which is kind of what Canadian National was really one of the first major Class 1s to implement that operating system. And then they kind of, a couple of years ago, they pivoted more towards growth and maybe not so much on the overall operations and profitability. And now that, you know, what we see is that they're kind of bringing back to their older school, if you will, principles of precision scheduled railroading, and kind of focusing on the things that, and by the way, precision scheduled railroading really is just like Six Sigma for the railroading industry. It's all about sweating your assets, reducing inefficiencies, and just trying to be as productive as you possibly can. What I would say is that in today, PSR is probably a lot more customer friendly than it was 20 years ago when the railroads would just tell the customers, this is what we're doing, deal with it. Now they kind of work at more of a collaborative environment to try not only to improve service and safety, but also to take those inefficiencies out of the network.
Yeah, I always was curious about that, because Hunter Harrison, of course, the late Hunter Harrison, a legendary figure in the industry, tightened up in that sense. But of course, the customers, I think, might not have always been delighted.
Yeah, and over the years, it's been implemented at different railroads. Some did it a little too fast, which was very disruptive. When CSX did it, it was very disruptive. Others took a more a disciplined approach, I would say, or measured approach. You know, what we're seeing at Union Pacific and Norfolk Southern. So, you know, I think the industry kind of learned from the mistakes of the past, but, you know, they are all embracing the PSR principles, just because it really can do a lot, like I said, in terms of reducing overall inefficiencies and driving better margins.
Of course, there seems to be more buzz about CP after its merger or takeover of Kansas City. They've got this network that goes down into Mexico, etc. If you had to compare the two companies, which have the greater growth prospects in the near to medium term?
I think you really have to look at it from a longer term perspective, because, you know, nearshoring is kind of like watching grass grow. It's very slow, and Canadian Pacific is really probably the best position to take advantage of that very slow secular growth trend. So over the long term, I think that CPKC has probably the most interesting growth prospects out of all the class ones, whether it's Canadian National or the ones that are based in the U.S. So that's kind of, when we're looking longer term, but we're looking kind of nearer term, I think both CP and CN have a lot of industrial development opportunities that they're trying to attract more business onto their networks. And, I think that is, crapshoot about which is outpacing the other.
Thank you very much indeed for joining us, Lee Klaskow.